So I came across this great article that talks about how Warren Buffett made a $1 million bet against this hedge fund manager to see who would get the highest returns in a period of 10 years, where Warren Buffett would only be investing in an index fund. Warren Buffett ended up winning the bet simply by investing in an index fund or an ETF that matches the S&P 500, that tracks the movement of the S&P 500. So I wanted to talk about whether this is a good idea, if it's a good strategy, does it really work? Should you just stop trying to buy individual stocks and just invest in index funds like Warren Buffett says? Warren Buffett being the greatest investor of all time. I mean, this is someone, if you are going to follow someone blindly in investing, it would be Warren Buffett. So he's trying to say that the average investor or the average individual will get better, or the best way for an average individual to invest their money is to simply buy ETFs that track the index. Because over time, no one beats the market, and by investing in an index fund or an ETF that matches the index, you're basically getting the returns of the stock market. So in my opinion, if you're looking for a passive investment, this is definitely a great way to invest passively. Really have nothing to worry about. You don't care about the ups and downs. You just keep buying an index fund, pretty much the safest because it represents the top 500 stocks in the stock market. So in terms of risk, it's pretty risk-free. You're just exposed to the general stock market, and over time you'll be making an average return per year. Here's why I wouldn't personally do it and why I don't think it generates the best returns. So if we take a 25-year period or a 25-year span, someone wants to invest for the next 25 years. And if you follow the strategy of just investing in the index fund, so let's say every year or even every month you buy the index fund regardless of the price. Every year or every month you buy an index fund with the same dollar amount. So let's just say $5,000. So every month or every year you buy the index fund with $5,000 for 25 years. So if you've been doing this since 1993, 25 years would be 2018. Your return for that 25-year period is 116%. So that's an average of 4.64% per year. So that's not that great, 4.64%. It's barely beating inflation. Now, the reason why this 25-year period does not generate the best return is because during that 25-year period, we went through two crashes. So basically when a crash occurs, it basically wipes out all the gains, all the profits you made in the past years. So all the years where you've been accumulating profits just got wiped out with a crash. And then a few years after the crash, the market rebounds and then you're back at the same profit level. So what took you 15 years to gain gets wiped out in 1 or 2 years, and then you'll have to wait like an extra 3 years just to be at the same level that you were 15, just to be at the same profit level you were at during a 15-year period. So that's one of the reasons I don't like this strategy, is because it's a long-term strategy, and because you're accumulating gains year after year, and then long periods go by, and then all of a sudden in 1 year, all the gains that you've accumulated in 15 years just disappear. So, and then you have to start all over. And depending on a 25-year period, it might not be beneficial. The idea behind the strategy is, in the long run, it averages out and ends up being more positive than, or more profitable than, if you were trading, buying and selling every year. This was good back in the 1960s, 70s, 80s, and 90s. We had a crazy growth, but this kind of growth is not going to happen again. So right now, our growth, you cannot compare the growth right now to the growth that occurred back in the 1960s, or that started in the 1960s, where, for example, Procter & Gamble was at $1, now it's at 85. You're not going to see Procter & Gamble trading 85 multiple right now in 25 or 30 years. It's always going to be in the same level, might go to 150, 200 max. So that 85 multiple, those crazy multiples that occurred from the 1960s to 2000 is not going to happen again. So that's why this long-term investing, buying and holding forever, or just following the index fund, it's okay for an average return, but it's definitely not the best return. And proof of that is Berkshire Hathaway does not invest in the index fund. Berkshire Hathaway buys and sells individual stocks. If we look at the 10-year period where the bet occurred, if you had bought the index fund every year or every month, you would have made an average return of about 7% per year. So it's average, probably even above average, but I mean, it's not the best return you can make on the stock market. It's great for a passive investment, a passive return. But luckily in those 10 years, no market crash occurred. So basically this bet happened right after the crash. So of course, it's all uphill from there. But if there was a market crash in those 10 years, the returns could have been much lower, if not inexistent. You could have been starting from scratch. So another reason I don't like this strategy is when you buy and hold forever, the return that you're making is an average yearly return, let's say of 5%. In the example of the 25 years, I gave you, you would have made an average return of 5% per year. But you miss out on compounding interest this way because you're not buying and selling. If you buy the index fund and it goes up in value 5%, for example, you're not taking that 5% and reinvesting it because you're not selling. That value remains in the stock, and if it drops, well, it drops. If it goes up, it's that initial investment that you put in that went up. It does not include that 5% gain. For that 5% gain to be included, you need to sell and buy something else and make another 5%. So that's how you get compound interest, is by making interest on gains. By making gains on gains. By making gains on gains. When you're not selling, you're not making gains. So you lose the compounding effect when you buy and hold long term. So it's actually best to buy and sell your stocks throughout the year and make a 7% return per year. 7% per year compounded for 25 years will be much greater than just 7% simple interest year after year. So that's why I'm not a great fan of that strategy of just buying the index fund, because you miss out on compound interest. So even if you're okay with 7% per year, at least get 7% compound interest. That would be good. 7% compound interest for 25 years would give you 17% average return per year versus just 7% simple interest. So that's why, in my opinion, I think it's best to buy individual stocks, buy and sell them, so you can make a consistent positive return every year. And with the effect of compound interest, your portfolio will grow much faster this way. And it's really not that complicated if you stick with blue chip stocks, if you stick with companies that don't disappear. If you look at the last market crash, only one big name company disappeared, which was Lehman Brothers. And they could have been saved, but for some political reason, they were not. And if we do get a crash, I don't think it's going to be as big as 2008. So I don't think it's going to be as detrimental as. So the chances are much lower that a big name company will go bankrupt or disappear. So yeah, so this was my opinion on the buying and holding the index fund long-term strategy. It's safe and passive for individuals that don't want to follow their investment. But even for the average investor, they could be doing much better by buying and selling individual stocks if they follow a certain strategy and focus on compounding their gains and compound interest and use the advantage of time versus just buying and holding the index fund forever. But I guess the bet was done to prove a point. Most people don't beat the market, and sometimes it's best to just follow the market. But I've explained in this video why I think it's best to buy and sell individual stocks, and sometimes investing in the index fund is not that beneficial because it's all about timing, right? So depending on the time that you need to withdraw your money, you could have just been through a crash a year or 2 years ago. So basically you wiped out all the gains for the past 10 or 15 years. So timing, it really depends on timing. When do you want to invest? How long do you want to invest for? And which period you're investing in also. If you just came out of a crash, then investing in an index fund is great, because most likely the following years after a crash will be positive returns, will be high growth. But right now, if you invest right now in an index fund, most likely in the next 5 years, there's going to be a crash or a strong correction. Or even right now, we're probably going through a correction right now. So investing in an index fund right now might not generate the best returns. So that's why timing is important. And the 25-year period from 1993 to 2018 is not the same as 25 years before 1993. You're not gonna experience the same growth. So that's also something to consider. So a reason why I also like buying and selling individual stocks instead of just investing in an index fund long term is when you buy and sell, or when you sell, your money becomes available to you. So there's more liquidity. So if anything happens, if there's a crash, well, because your money is available, then you could take advantage of of a new discounted price. So it increases your chances of having money available to purchase new stocks. So let me know what you think. Leave them in the comments below. If you have any questions, also leave them in the comments below. You can also email me directly on my website. Remember, if you can open an account with Questrade to trade on stock market, use my referral code in the description below the video. So you can get between $25 and $250 depending on your initial deposit. If you like this video, please like, share with your friends, and subscribe to the channel. Thanks for watching.